Hi, both. Thanks for joining us today on our Business Gurus channel, where we will be discussing key business topics to help students grasp the most important elements of their course in preparation for their exams and future career. Let's get started.
Welcome to the deep dive. Today we're tackling something you hear about constantly: interest rates.
Absolutely. They're everywhere in the news.
Right. But have you ever really stopped to think how some decision made, centrally, maybe in London, actually affects whether you decide to buy a car?
Or get a mortgage, yeah.
Eh.
Or even just what happens with your savings account next year.
Exactly. So, our mission today is to really unpack what interest rates are at their core and look at their, well, surprisingly huge impact on your everyday financial life. We're drawing straight from the sources you sent us.
Mm-hmm.
So, let's start right there. Fundamentally, what are we talking about? Interest rates.
Simply put, it's the cost of borrowing money.
The cost.
Or, flip side, it's the reward you get for lending your money out, like when you save.
Got it. And you said cost, but that's not just some abstract number, is it?
No, not at all. It's incredibly tangible. It directly hits things like your monthly mortgage payments,
Right.
your credit card balances too. And, really importantly, it affects how businesses get the loans they need.
Yeah.
Just to operate or maybe to grow.
Can you give an example, like how tangible?
Sure. Say the interest rate on let's say, 250,000 pound mortgage goes up by just 1%.
Okay.
That could easily add maybe 50 pounds, 60 pounds extra onto your payment each month.
Wow. Okay. Yeah, that really puts it into perspective. That's money you don't have for other things.
Exactly. Hits your disposable income directly.
Okay, so let's unpack that link then. If they're the cost of borrowing, how do these rates actually, change how we calculate things or spending choices?
Well, what's fascinating is the direct behavioral effect. It's quite logical,
Yeah.
really. When the cost of borrowing money goes down, so lower interest rates, it just naturally encourages spending.
Makes sense.
Think about it, yeah. Big things like houses, cars, maybe even that dream holiday.
Right, the big stuff.
Yeah, they suddenly seem more affordable because the monthly payments are smaller. It just sort of lowers the barrier to taking out that loan. But when that cost rises, well, then consumers are much more likely to pause. Think twice,
Because it's more expensive.
right? Borrowing costs more, so suddenly saving, or maybe paying off debt you already have, looks a lot more attractive.
So it shifts the mentality.
Definitely.
Yeah.
You see a shift maybe from a spend now feeling to more of a safer later approach.
And it's not just us, the consumers, feeling this, right? You mentioned businesses earlier.
Oh, absolutely. Businesses are just as sensitive, maybe even more so in some ways.
How so?
Well, these rates significantly impact their crucial ability to borrow money, capital for survival or for growth,
So a small change could stop a project?
easily. A slight increase in the rate could make a planned investment, say buying new equipment, expanding a factory, suddenly look, well, unprofitable, not viable anymore.
Right, because the cost of financing it just went up.
Precisely. For any business, capital is like their lifeblood. And the interest rate, that really sets the bar for whether a new project makes financial sense.
Okay, so this is clearly powerful stuff. Who actually controls this? Who's setting these rates that affect everyone?
Yeah, what's absolutely vital to understand here is the key player setting these rates for the whole economy. In the UK, it's the Bank of England, the BOE.
The Bank of England. Okay.
And when we talk about them setting rates, what they're really doing is adjusting something called the bank rate.
Bank rate.
Yeah, that's the official interest rate. The BOE charges commercial banks to borrow money from them. Think of it as the base rate.
And that flows down to us.
It cascades down, exactly. It influences pretty much all other interest rates in the economy. Personal loans, business credit lines, mortgages, savings rates, everything.
Wow, okay. So the Bank of England has this really powerful lever. If we connect this to the bigger picture then, what's their goal? Why are they adjusting this lever? What are they trying to achieve?
That's a really important question. What are they aiming for? Essentially, the Bank of England uses interest rates as a fundamental mechanism.
A mechanism.
Yeah, think of it like the economy's accelerator pedal or its brake. They use it to help control the overall level of spending in the economy.
Control spending. Why?
Mainly, crucially, to manage inflation.
Inflation. Okay. Keeping prices stable.
Exactly. If prices across the board are rising too quickly, eroding your purchasing power, making your savings worth less,
Which nobody wants.
right? The BOE might raise interest rates to sort of cool down demand, make borrowing more expensive for everyone, consumers and businesses.
Which should mean less spending.
That's the idea. It incentivizes less spending, which then helps to bring that upward pressure on prices back under control.
And the opposite if the economy is slow.
Conversely, yeah, if the economy seems to be stagnating, maybe heading towards recession, they might lower rates.
To encourage borrowing and spending, get things moving.
Precisely. Try and stimulate activity. But it's a really delicate balancing act.
I can imagine. Trying to keep inflation low and stable, but also supporting economic growth.
Exactly. And it's not instant either. There's what economists call a transmission mechanism. Changes in the bank rate can take, several months, maybe even longer, to fully filter through and have their impact on the wider economy.
Right. It takes time for the ripples to spread out. So, okay, understanding that this one decision, this bank rate, has such a profound effect. I mean, on everything from your mortgage, like you said, to the health of businesses, maybe even jobs. What does this really mean for you, the listener, for your next big financial decision, maybe? Or even just how you think about your savings?
Yeah, how do you factor this in?
So let's quickly recap what we've deep dived into today. Interest rates, they're definitely not just numbers on a screen.
Far from it.
They're a fundamental economic tool, primarily set by the Bank of England's base rate here in the UK. And they directly influence whether you're more likely to buy something big or save your money.
And also how businesses operate, whether they invest and expand.
Right. And the big goal behind all of this is managing inflation, keeping our economic landscape hopefully stable.
So, knowing that interest rates are this primary tool for, steering the economic ship, and that they directly hit both how consumers like you behave and how businesses act, maybe the final thought is this. How might you start integrating this understanding into your own future financial planning?
Good question.
Yeah, whether that's thinking about a new loan, looking at your investments, or even just that basic decision between spending versus saving right now. How does knowing this change your approach?